people living in different countries come to New Zealand and they're still tax residents in different places, like what should they worry about, and who are the type of people that should worry? They're not paying the bill.
So, in the last few months, we've had prospects and clients coming us for help because they received IRD risk review letters saying they've not declared overseas income, which they should have as a New Zealand tax resident. And it is quite common now that we've seen there's a lot of automatic kind of information sharing between the tax authority and the banks, as to with the tax authorities as well. So IRD definitely have more information and be able to track down these people easier than they did before. When overseas income are not reported, they should have, then that means tax is underpaid. And then when tax is underpaid, then the implication is there's interest and penalty that may accrue if tax is underpaid for the years concerned. So, and it can snowball, especially when there's a really old kind of historic kind of debt tax bill. So so we encounter that quite regularly in the last quite often now than we have before. And IRD have received more budget and doing investigation around this. I think we've heard announcements how IRD will get more resources and budget and doing more investigative work. So we are kind of anticipating seeing more and more of these cases coming to light.
So they're coming for you. So you got some income overseas, and then the IRD's threatening you. What actually happens? Like, so you don't pay it, and then you have to pay interest on it, and then you get a warrant out for your arrest, and you go to prison, and then they take your house, or what's the progression?
No. So when a person receives an IRD risk review letter, they have the chance to do a voluntary disclosure to tell the IRD everything. So all hands on the table, all cards on the table. So then they would then decide, okay, well, these are the things they usually get an accountant to do it for them and not do it themselves, because they don't have that kind of accounting knowledge, because otherwise they would have already declared that income right before, but because they didn't, so they usually get an accountant involved, and so the accountant would write up like a voluntary disclosure letter telling the IRD what are the reason why the income was omitted, what were the periods that were affected, what are the income and calculations of income that should have been reported. And then what we also do for our client is a reassessment and assessment kind of calculation, which shows the difference in the underpaid tax or the overpaid tax, depending on which way it goes. Because what IRD knows is that something is not reconciling, but it doesn't actually always mean underpaid tax, because what if there's actually expenses more than income in that sources of overseas income. So yeah, it can go both ways. You don't know until you've done the calculation.
Just make sure I get it. So, all right, you're chilling. You just moved here from overseas, and wait, what's the situation for them? For example, is it like, so I come to New Zealand, and then once I'm a resident, then I have to worry about tax. You have to pay tax immediately, or are there some countries where you don't have to pay tax, or what are the type of people that have this problem?
New migrants usually don't have this problem until after the fourth year, because there's something called the Transitional Residency status, which provides a 4-year foreign income exemption on most foreign income. So the new migrants probably don't have that kind of problem, as well as returning expats. But they have to be out of New Zealand for more than 10 years in order to qualify for the transitional residency status. There are certain criteria to meet for a person to be eligible for the transitional residency status. And if they're eligible, most of the foreign income are treated as exempt income, so they don't need to report. And so people who probably need to think about this and report overseas income are people that are after that transitional residency status. So they've already been in New Zealand for more than 4 years. they've landed here after 4 years, then you think about reporting overseas income. And if they don't, then IRD may track it and then require them to report it. And going back to that previous question you're asking, so what could be ways that did people get hit with penalties, interest, and things like that? In our experience, we were able to successfully remit 100% of the penalties for our clients, and it's because that's the fault because because the clients have fully disclosed, do a voluntary disclosure, and not had any other income from the IRD, and so they took that chance to do that, and then by doing that they get 100% penalties remitted. However, use of money interest is usually a little difficult to remit because it's kind of IRD's loss of the use of that money, so they usually still impose that use of money interest to taxpayers unless there is exceptional circumstance why the taxpayer omitted that income. So, but there needs to be some quite extraordinary circumstance for use of money interest to be remitted. And usually we also would suggest that our client disclose the last 4 years of income. So if they've omitted like 10 years of overseas income, but we would try to request to limit 4 years as a catch-up of all the outstanding years instead of doing 10 years of reassessment of returns. So that's another strategy that we would use, is to limit it to the last 4 years. And usually, based on our experience, IRDs are usually quite happy with that approach. So yeah, we haven't had much pushback from the past, and we've had successfully got our clients the last 4 years to catch up with the outstanding years, as well as 100% remission on the penalties. So those are the great outcome that we were able to get from our clients.
So just to make sure I understand. So, all right, someone has been here for at least 4 years, and now suddenly they get notified that there's this tax bill, but the IRD is not sure exactly how much it is or what the expenses are, or they have a bit of an idea. And then you do a voluntary disclosure that seems to go pretty good in terms of not having penalties. And there's also, if you've missed payments for 10 years, there is a hack where you could potentially reduce your tax owing down to 4.
Yeah. That's right.
Okay. And then what do you mean? What happens during that first 4 years? So you move to New Zealand, you're here 4 years. Are you just not paying tax anywhere, or paying tax back home, or what's happening?
Just overseas income, most foreign source income are treated as exempt income. The two carves out to that transitional residency status is foreign employment income and foreign personal services income. So say if someone, as an example, if someone is eligible for the transitional residency status, and say they receive overseas rental income, but under the transitional residency status, that's treated as exempt income. So what that means is that they don't need to report overseas rental income in the New Zealand return, but they still need to continue reporting New Zealand sourced income. So say New Zealand employment income, New Zealand interest, that they're still subject to New Zealand tax. It's just the foreign source types of income. And the two carves out that I mentioned, foreign employment and foreign personal services income, those are not part of the transitional residency status rules. It's still subject to New Zealand tax from the first day of arrival. So say if someone comes to live in New Zealand and work remotely for an overseas company, that is still subject to New Zealand tax, during the first 4 years. That's not exempt income. So yeah.
So essentially, if you still got a job overseas, you move here, you get a job in New Zealand, you got to pay tax over there and here. Oh, yeah. That makes sense.
They don't pay tax. Yes, they pay. They might get withhold tax overseas, and then they will have to pay tax in New Zealand. But chances are that New Zealand has the first tax in right to that income because work is performed in New Zealand. So the overseas tax authority shouldn't have withheld the tax if they did withheld. So then they have to go back to the overseas tax authority to try to get the refund. So they shouldn't end up with a double taxation situation if New Zealand have a double tax agreement with the other country. And New Zealand's got various double tax agreements with various countries. So, yeah.
Can you explain double tax agreements? I mean, obviously some might not have it, but like not necessarily what's in it, but like what's the point? So it just means you only one country will tax you, and they've agreed that, or what's a double tax agreement?
Yeah, the double tax agreement is there to provide relief on double taxation on the same income. So if you say, for instance, if the other person is from UK and that UK employment and there's a UK employer that pays to the New Zealand tax resident the UK employment income because they're working remotely for the UK employer. New Zealand wants to tax this person because that person is a New Zealand tax resident. So then we end up with a double tax situation where UK employer withholds tax to the UK tax authority. The New Zealand IRD wants a right to tax that income because work is performed here. And then we then look at the New Zealand UK double tax agreement to see which country has the first taxing right. The country that has the first taxing right will get to tax the entire income. And the country that doesn't have the first taxing right, they would be able to claim a foreign tax credit for the tax paid in the other country. So then tax is not paid twice. And that's how we would work in practice. And the double tax agreement would tell us which country has the first taxing right and which country doesn't. And so we know whether which claim foreign tax credit in the New Zealand return or not.
So what's the setup? So let's say you should you have an accountant back there and an accountant here, and then you introduce them via email, or what's the execution of this?
Yeah, we work with the accountant from the overseas jurisdiction, to kind of make sure that our client is not hit with double tax on the same income. Yeah.
And what's that five thing? FIF, do you know much about that?
The
Foreign
foreign
investment.
investment fund rules, eh?
Yeah.
That's what you're referring to, yeah. Yeah, so that's where when a New Zealand tax resident invest overseas, like shares, ETFs, and when they are not Australian listed stocks, because there are exemption to the foreign investment fund rules, like there's more than 10. So when we look at the foreign investment fund rules, we would check whether any of the exemption applies. If the exemption applies, then we don't need to consider the foreign investment fund rules. If none of the exemption applies, then yes, the foreign investment fund rules then apply. And then we need to calculate foreign investment fund income using the five formulas. And depending on the facts of the case, we then have to look at which formula is which calculation method is most appropriate in that case. And I mean, there's a few kind of exemptions that are quite common. One of them is the 50,000 cost. So if the foreign investment fund cost, so the cost of investment in these foreign shares are less than 50,000, then you don't need to apply the foreign investment fund rules. What that means is that you only report dividends on cash basis, so upon receipt. So it would simplify things because the foreign investment fund rules is actually taxing income on accrual basis. So even if you've not received any dividend, it could be deemed income under the foreign investment fund rules because it tax income on accrual basis. So yeah, so that and then that's yeah.
Use some fancy words there. So what's an example? So like I invest, I don't know, 45 grand in some US company, and now I've got to pay tax, or I don't have to because it's less than 50 grand. I don't quite, what's an example? What you said?
So, shall I go using your example there? 45,000 cost. That's NZD, right? That's invested
Yeah,
into and did you say which country stock? Did you say?
the United States into like a company.
Yeah.
I don't know, you buy Tesla.
Yeah. Okay. Then, so say Tesla would say, maybe make some dividend payouts, say, say maybe they made a dividend like today, say 16th of January. in 16th of January, then it falls in the 2025 New Zealand financial year. So then it's in the 2025 New Zealand return that you report that Tesla dividend.
Okay, so you have to pay tax on the dividend, but you don't have to pay tax on. Like, I didn't quite get the 50,000 cost. Do you mean 50,000 invested, or the actual cost of the fund is greater than 50,000, like the management fee or something?
No, that is the cost of the purchasing the Tesla shares using your example.
All right. So, like, if it only costs me, I don't know, like a transaction cost of 0.2% or whatever to buy those shares, is that what you mean by cost, or do you mean the funds under management, the amount invested?
Not invested.
Is it the total amount invested? Like, let's say I have Tesla and I have Apple and I have Microsoft. Is it the total of all those investments?
That's right. That's right.
So as soon as you get over 50 grand invested, then you got to start paying
Yeah.
tax.
Yeah. The other thing that we would check in the portfolio is if there's any Australian listed stocks, because Australian listed stock is also another foreign investment fund exemption. So we'll probably have to go through the portfolio in a fine tooth comb, making sure there's no Australian listed stocks, because if there is, then we need to subtract that out from the other the ones that falls under the foreign investment fund rules, and then see if it's going to be under the 50,000 or not. Instead of just taking the total without checking the shares that's in the portfolio. So you just need to make sure what falls under the foreign investment exemption takes out of the calculation of the 50,000, because that's not part of it, because it's treated as exempted, right, from the foreign investment fund rules.
So when you find an exemption, that reduces the balance of the 50. Like, let's say you've got 20 grand exempted, but you've got 50 grand over there. You're like, oh, well, actually, that's 30 grand. Like, I'm exempted because of that 20. Huh. Interesting. Okay. And then, so do people get stuck on any other things, like from particular countries? Like, I think you have to still be a tax resident to be a citizen of America or something like that. And what happens if you sell a house in Australia and come in? Is there things where people get caught up on?
Yeah, when they sell a house in Australia while still a New Zealand tax resident, we will need to check whether, because then as a New Zealand tax resident, New Zealand and foreign source income are subject to New Zealand tax as a general, right? So if they sell, say, an Australian property, say a residential house, and whether they are New Zealand tax resident, we actually need to consider whether the proceeds from the sale of the Australian house is subject to New Zealand tax or not, because we have to determine, is it subject to New Zealand tax under the New Zealand tax rules. So even if Australia doesn't tax it, but if New Zealand does, then we still need to for it to include it in the New Zealand income tax return. Like, the bright line test is an example where capital gains can be taxed. So say you buy and sell within 2 years now, because it's from 10 years now down to 2. The change in rules. So if you buy and sell within 2 years, then it might be caught under the bright line test. So just being careful with that if you do sell an asset overseas while being a New Zealand tax resident, just maybe just to seek some advice before you do so. Because once the transaction is passed, then that's it. And that's, as a tax advisor, we can only work with, the facts. And so you can't, and if there is adverse tax consequences, it might be hard to reverse, because the transaction has already gone through. But if the transaction hasn't gone through, and if the taxpayer seeks some tax advice and did some tax planning, and maybe there might be a chance to reduce the tax liability with the transaction, and so maybe it's to seek some tax advice before selling off any overseas assets or receiving any overseas income as a blanket approach. Because
Makes sense. I mean, like the Brightline test always confused me. It's like, there's no capital gains tax in New Zealand, but if you flip a house, it's income. So we're going to tax the gain that you got from the house, which is kind of bizarre. So like for example, in that scenario, if you own the house for at least 2 years, then it's not going to be a problem of selling the Australian and paying tax with Brightline here. Is that kind of the gist, or?
Not necessarily, because the bright line test is only one of the section of the land taxing provision. So the land taxing provision is like from section CB6A to section CB14. So when we advise our client whether there's any New Zealand income tax implication from the sale of the overseas property, we will actually look at each of the sections and make sure that the transaction doesn't fall within any of the section. Because if it does, then when you look at well, does any of the land taxing exemption applies? Because if the exemption applies, then it's out of the tax net. But if none of the exemption apply, then yes, it is subject to New Zealand tax. So even though New Zealand doesn't have a comprehensive capital gains tax regime, but certain parts of the New Zealand Tax Act can still tax on capital gains.
Yep.
So we just don't have a capital gains tax regime, but we may still tax on capital gains on certain parts of the act. Another one that might tax on capital gains is just the personal property section, where say if you've got a painting at home, and if you purchase that painting with the intention of resale at the time of acquisition, then that may be taxed under it may be taxed under New Zealand tax law. So yeah, these are those little, I think, devils in details that may be worth just to get advice from a tax advisor before actually going through that transaction.
Yeah, I think fundamentally it's like, if it's same thing with like investing, like if you're investing with the intention of making an income, then I imagine you're probably going to get taxed. Just, I guess, is the overarching principle, like if it can be perceived as income or you're doing it with the intent to make an income, then you're probably going to get taxed. Is that, or is there like a principled approach that you've noticed with IRD and the way they approach things?
I think for personal properties, and also the real property, I think intentional resale at the time of acquisition, that's quite key, and it might be sometimes hard also to prove you don't have that, intent. You need some proof to say you don't have the intention. And if I do kind of ask you, provide me support that you don't have intention of resale at the time of acquisition. Has
that happened? Have they had to show like a photo and like the vision board you did with your family that we're going to stay here, and then you invested in a high school? Like, how do you prove that you didn't have intent?
The onus is with the taxpayer to prove that they don't have the intention. And so there could be correspondences with professionals or some sort of mainly correspondences, I think, and also actions, how that kind of what shows that they've not an intention of disposable.
Do they ever get out of it, or does it
Easy.
not work?
Yeah.
Is it very hard to get out of? Like, we're like, oh no, look, I've got 10,000 pages of me saying how much I love this place. I'm going to be here for the rest of my life. Like, is it hard to convince them? Like, or have you seen anything in terms of people trying?
I actually personally haven't had to deal with disputing the intention of resale at the time of acquisition myself. So, but I do know that the onus is with the taxpayer, and so it would be good for the taxpayer to keep support that they don't have the intention with us, through correspondence with other people or through certain actions that may show that they don't have the intention to do that. So just so that if an event of IRD query in the future, they've got that, to provide to the IRD that to kind of shelter themselves from.
Well, that's like an intent in a way. Like, if you think about it, so you're like, I'm worried that they're gonna think I have the intention to sell, And so I'm going to prepare in advance to make sure I can prove the video. That's weird. So what else do people get stuck on? Like, so yeah, they moved here, they passed the 4 year. With the 4 year thing, so you're just exempt for the first 4 years, and then from there, for the next, say, 6 months after that, then you're not exempt if you're still receiving an income.
Yeah. So it's recommended that if people do have significant overseas income and investment, is to get some tax advice before the 4 year lapses. So they could do any tax planning if they need to, or dispose of any overseas income or assets that they don't wish to keep receiving after the 4 year. Because it comes with compliance costs and all, other costs as well. Because if the benefit of holding on to those overseas investment and getting that overseas income um, doesn't outweigh the cost, then it's kind of not worth it of holding on to them, and they might as well just dispose of it before their 4 year lapses and then just keep what is worth keeping.
What's an idea of cost that they pay? So I get it. So you got these investments overseas. You've got 4 years to think about if it's worth it. But what is the sort of cost if you kept it? Like, is it personal tax rate? Does it depend on each country? Is it what's sort of an example of how much someone might pay for waiting?
Say, depends on the type of overseas income or asset. So for instance, if you have like overseas shares, like US shares that we're talking about, Tesla shares, to keep holding on to them after the 4 years, then we need to look at foreign investment fund rules. If they apply, then the accountant needs to do kind of calculation, which means that compliance accounting fees might go up. And because there's additional calculation that needs to be done under the foreign investment fund rules. With overseas property, overseas rental income, the accountant needs to work out what is the net rental income or loss for the year each year. So mainly, I think accounting fees and tax exposure for if someone were to continue to keep it, because the foreign investment fund rules is taxed on accrual basis. So even if that person hasn't received any dividend, they still need to report that income potentially, under the foreign investment fund rules. The foreign investment fund rules doesn't essentially mean that there's definitely income to report each year, because it can be nil. Because if in one of the formula, so for individuals, they can either choose the fair dividend rate method or the comparative value method. If the comparative value method, that results in a negative amount, because we could take the lower of the two methods, and so a negative meaning a zero. So we could use zero, basically zero. There's no negative in terms of foreign investment fund income. So we could say, okay, that's nil that year, because you could take the lower of the fair dividend rate method and comparative value method. So that year, then there's no foreign investment fund income to report. But the calculation still needs to be done. The accountant still needs to do the work, or we could say, oh, yeah, there's no foreign investment fund to income to report that year. So there's still kind of compliance costs.
Yeah, okay. So you got this thing, the FIF thing, that if you have less than 50,000 and there might be some exemptions, you might have to do it. And then there's two formulas to calculate it, or is there three, or is there 10? Just two.
There's five, but then for individuals and trusts, the appropriate method is the fair dividend rate method or the comparative value method, whichever is the provides the lower result. And then the other method kind of falls into the other situation that's relevant. Say there's the cost method. So cost method is where if someone were to kind of doesn't have, if the stocks were not Tesla, it's stocks that is with a private company, so there's no market value to use, then they could use cost, because the cost being the amount they have invested into the shares, to calculate under the cost method. So depending on the facts of the situation, then the method to use under the fifth rules may change.
Okay, so you got 5 different formulas you can use, and you try to use the one that's appropriate as well as the one that leads to the cheapest that you have to pay. What do you actually pay? Is it like
Yeah.
your personal tax rate? Is it
Yeah. Personal tax rate, correct.
on capital
Correct,
gain
yeah.
or just dividends?
Foreign investment fund income, it's the foreign investment fund income, so it's not dividend or capital gains. It's their calculation of the foreign investment fund income. So, for instance, fair dividend rate method, they take 5% off the opening market value. So that 5%, it's not really like dividend or capital. It's just that the market value of the portfolio, and then under the fair dividend method, 5% of that opening market multiplied the opening market value, and then plus any quick sell adjustment. So any per buy and sell within the same income year. There's also another formula calculation to add on top of the 5% times opening market value. So, but I mean, in short, like to keep things simple, we just say, okay, 5% opening market value, that would be the fifth income under the fair dividend method. And then with the comparative value method, it essentially takes the capital gain or the loss that year, and also depending on the currency fluctuation, to work out under the comparative value method, is a positive number or a negative number. If it's a negative number, that year we could say it's no foreign investment fund income. If it's a positive number, then we would compare it with the fair dividend method, which is the 5% of the opening market value, and see which one is a lower amount. And the lower amount would be the amount that we would use to put in the New Zealand tax return for the foreign investment fund income.
Interesting, yeah, because like, you know, in New Zealand they had the portfolio investment entity, which is like a relatively tax efficient way to own a whole lot of assets, like KiwiSaver is a portfolio investment entity, and then there's a cap on how much you tax, and your personal tax rate might be higher than the actual portfolio investment entity tax rate. But within that, it's only the things that would be considered income, you know, like dividends or bonds interest. So I'm wondering, why does the FIFE or FIF just base it? So it's like 5% of the whole value, and you got to pay tax on that, and it's income. So if I have $1 million, I have to pay $5,000. I have $5,000 of income that year. 50 grand,
50
sorry,
grand.
bad math.
50 grand of taxable income, and then you work out the tax liability on the 50,000 of foreign investment fund income. They're just saying the max. So essentially, the max they will tax you on the foreign investment fund on the foreign investment is that 5% of the opening market value. Because if the comparative value method provides a higher amount than the $50,000, then you still take the lower of the two, right? Then it'll still be capped around 50,000. 5% of the opening market value being the max they would deem as income under the fifth rules.
What happens if it grows or doesn't grow? Like, do you have to pay tax, or is it just you can go with whatever one you pick and they'll hold you to it?
If it doesn't grow, then maybe the comparative value method might have a negative amount, and then there's no fifth income to report that year. If it grows,
so you can change it every year, can you?
Yeah. Well, each year you would calculate under the fair dividend method and comparative value method. You calculate both, and then you take the lower of the two.
Oh, so is this like, so you have to pay the bill ahead of time or something, and then when it comes to actually pay the bill based on what really happened, does it change anything? Like if I do the 5% open market, so I buy a Tesla, it's $500,000, and I say, okay, I'm going to pay 5% tax on the 500,000, but then a year later it went to 300,000. It's worth nothing. Like, does that change anything? That's part I don't get.
Sorry, can you go back to repeat that?
So I don't quite understand. Like, does it matter what actually happens? So you do this calculation, and you're trying to guess what's going to happen. You're like, oh yeah, 5% of this opening value, I'm going to pay tax. And then you find out later that the share price was really bad and it didn't do good. Does that impact anything, or you pay less and you recalculate it, or that part?
If the share value went down then last year, there might be a chance that the comparative value method is a negative amount. If there's a negative amount, then it means that if we could take because we could take the lower of the two, then that would actually result in zero foreign investment fund income for that year.
Do you pay the tax before it happens, or do you pay it at the end?
No, you pay the tax after the financial year. Well, you work out the foreign investment fund income when your accountant does the income tax return, and then the tax bill the terminal tax liability doesn't come until 1 year after the financial year ends. So, so if the taxpayer is with a tax agent, then the 7th of April after the financial year end. If the person doesn't have a tax agent that to file their return, then it'd be 7th of February after the financial year end. So it'll be almost a year before they actually pay the tax bill.
Okay, so it's all done now. You decided you need to calculate your tax, and you got these 5 different options. 2 of the ones is the most commonly used, and then you just pick the lowest one, and then
For
you're good.
individuals and trusts, yes, for individuals and trusts, and then the other methods are more for other kind of situations, and yeah.
All right, well, cool. Well, thanks for teaching me about tax. The podcast is done.
You're welcome.